What is up, everybody? Welcome back to the channel. Today I wanted to give you my top 5 reasons why the housing market may crash in 2022. I will share with you the data and the research that I have been following that suggests a potential housing market downturn by the end of the year. That way you can stay up to date on what the housing market is doing so you can make the most informed decision whether you're a buyer, a seller, or an investor. My name is Jay Costa. I'm a real estate agent and investor here in Northern New Jersey. And if you get any value or enjoyment out of this video at all, please smash that like button down below. It really helps me grow on YouTube. Now onto the video. So on this channel, I try my best not to be the typical doom and gloom real estate guy that's talking about an imminent housing crash every single day. But on the other hand, I try not to be the typical real estate agent that is always saying that the real estate market is going to go up no matter what. Neither of those are true. 99% of real estate agents out there have an uncanny ability to just say what they're programmed to say no matter what's going on around them. I swear, I guarantee there's real estate agents in Ukraine right now trying to sell real estate. Is that too soon? The point of this video is not going to be to scare you or even dissuade you from purchasing real estate in the year 2022, but rather just provide you the data points and the trends that you need to know about that may affect the housing market going forward. In fact, in my next video, I will share with you the top 5 reasons again why the housing market will not crash. So stay tuned for that by subscribing and hit the notification bell down below and you'll be alerted when I post it. Now on to the video. So the housing market has not faltered really at all since the early 2010s, going up consistently from 2012 all the way up to 2020, early 2020. And then COVID pandemic hit. And since then, the housing market has gone absolutely crazy, as we're all aware, growing 15 to 20% each year. All-time low interest rates, along with some societal changes as well, boosted buyer demand to extreme levels, some would say artificial levels, pushing home prices up for what seemed like every single day. So that brings us to our first reason why I believe that the housing market may crash in 2022, and that is the rising interest rates. As we all know, the Federal Reserve has decided to raise the federal funds rate by 0.25% and plans on raising that federal funds rate another potential 6 times by the end of this year. The mortgage market has already started to factor this in, going from a low of 2.77% on a 30-year fixed rate loan all the way up to almost 5% as of the time of this video, March 30th, 2022. Mortgage rates obviously directly affect the buyer's purchasing power in real estate. In fact, every 1% that your 30-year fixed rate mortgage rate goes up, that means that your purchasing power as a buyer goes down by 10%. We're already up over 2% from the low on the 30-year interest rate. That means that the buyers have lost over 20% of their purchasing power in this market. That is massive. That is a massive change. I actually went into more detail specifically on what I think the interest rate environment that we're in now is going to do to the housing market going forward. Check that out in the description box down below, and I'll put a little link up here. Check that out after watching this video and let me know what you think. But my thoughts on rising interest rates are fairly simple. The higher mortgage rates go, the lower the buyer's purchasing power is. And the lower the buyer's purchasing power is, the lower they're able to spend and to offer on property. If and when mortgage rates go over 5% and close to 6%, the buyer demand will be very dried up. Home prices will start to stall or even modestly decline, and all you'll hear about on the news 24/7 is how the housing market is about to take a huge downturn. What will that do to both buyer and seller sentiment? Well, I think you're going to have a flood of sellers trying to cash out quick, but they already missed the boat and they're not going to get the offers that they're looking for. It's also important to point out that in real estate, home values are directly connected to the comparable sold properties in your neighborhood. So all it takes is one property selling for less than what was expected, and that comparable property, we call them comps, that's out there, and that immediately affects your home price on any appraisal going forward. So my point is the real estate market and home prices can change very quickly, quicker than you think. The second reason that the housing market may crash in 2022 is foreclosures. Foreclosures as of January of this year were up 700% year over year compared to January of 2021. That is insane. Now, of course, most of that massive jump is because of the foreclosure moratorium caused by the pandemic, where banks and lenders were not allowed to foreclose on anybody for almost 2 years. And most of these foreclosures were actually already started pre-pandemic. They were just put on hold until now. So even even though this doesn't indicate that these recent home buyers that are buying at these high inflated levels are already defaulting on their loans, that's not happening. But it is still a potential sign of a lot more inventory and a lot more distressed inventory coming onto the market pretty soon. Basic supply and demand economics would tell you that if demand is down because of higher interest rates and inventory is up because of foreclosures coming on the market after 2 years, home prices are set to fall. I personally do a bit of work with REO properties as a real estate agent here in northern New Jersey, and obviously I haven't done anything in the past 2 years for these companies and these lenders, but I have seen it pick up recently. As of right now, I have 3 REO properties that I am working with the lender on in order to get ready to put on the market. And remember what I said, all it takes is one foreclosed house on your street or in your neighborhood to sell for a pretty low price, and that comp is out there, and they're going to be looking at that comp in the future to compare your home's value. Now, the last 3 reasons why the housing market may crash in 2022 are actually brought up by the Federal Reserve of Dallas. The Federal Reserve of Dallas just yesterday released a study, which was an analytical report showing the potential indicators of a housing market bubble. The first sign of a tipping point that they cite in a housing market bubble is FOMO, fear of missing out. The Fed explains that, quote, real house prices can diverge from market fundamentals when there is widespread belief that today's robust price increases will continue. If many buyers share this belief, purchases arising from a fear of missing out can drive up prices and heighten expectations of strong house price gains. This self-fulfilling mechanism leads to price growth that may become exponential or explosive, resulting in the housing market becoming progressively misaligned from fundamentals until investors become cautious, policymakers intervene, the flow of money into housing dries up, and a housing correction or even burst occurs. That is some scary language, especially coming from the Federal Reserve and not some Yahoo on YouTube. Although nowadays, I don't know who to trust more anyway. They composed a graph showing times of what they call, quote, exuberance, which is when prices are growing at such a rapid pace that they're disconnected from what the fundamentals would justify. As you can see in the chart, the housing market has shown signs of so-called, quote, housing exuberance for 5 consecutive quarters, and we are at the lowest level since 2007. The Dallas Fed then uses a more diagnostic approach in order to assess the U.S. housing market at this point. The first data point that they use to show the current unhealthiness of the U.S. housing market and the number 4 reason why I believe the U.S. housing market may crash or fall in 2022 is the price to rent ratio. Basically, the Fed argues that just like a stock trading at a really high PE ratio, price per earnings ratio, the US housing market is currently trading at a price to rent ratio that is way too high. They argue that, quote, the gap between the actual price to rent ratio and its fundamental based level in the US has grown rapidly during the pandemic, comparable to the run-up of the last housing boom, and started showing signs of exuberance in 2021. The exuberance statistic confirms that recent increases are far from ordinary. The Fed's second data point that they use to show the unhealthiness of the U.S. housing market, and the number 5 and final reason why the U.S. housing market may go down and or crash in 2022, is price to income ratio. Price to income ratio is exactly what it sounds like. It's basically home prices as a ratio compared to the U.S. consumer disposable income. This is tied directly to housing affordability. Now, if you look at the graph here, it actually shows that price to income ratio is not above that red 95% confidence upper bound indicator there, but the Federal Reserve of Dallas argues that it is about to be. The Fed also states that there was a, quote, delay in elevation of this exuberance statistic, partly the consequence of a surge in real disposable income during the pandemic that led to slower growth rates in the price to income ratio. The surge in disposable income is mostly associated with pandemic-related fiscal and monetary stimulus efforts and reduced household consumption arising from mobility restrictions and lockdowns. So basically, the fiscal and monetary policy and stimulus that the federal government provided during the pandemic artificially inflated everyone's disposable income, obviously, and that completely screwed up the price-to-income ratio here. But now that all of that stimulus is pretty much completely over with, it will be very interesting to see where we go from here. It is very likely that that price to income ratio will be completely disconnected if it isn't already, because these are lagging indicators with this data. So, is another housing bubble about to burst? Well, the Fed and I are in agreement. There are clear reasons for concern after looking at all of these data points and trends. These economic indicators are concerning, and these 2021 housing prices were completely out of step from reality and the fundamentals. But the Fed also states that if there is a correction of some sort in the US housing market, that, quote, there is no expectation that fallout from a housing correction would be comparable to the 2007 to 2009 global financial crisis in terms of magnitude or macroeconomic gravity. Among other things, household balance sheets appear in better shape, and excessive borrowing doesn't appear to be fueling the housing market boom. They are 100% correct here. The 2008 housing crisis was mostly caused by giving mortgages to people that could not afford them. Whether that was the lender's fault or the borrower's fault, that's on you to decide. It's probably a little bit of both. But they were giving out mortgages with no income verification, no money down. You didn't have to show anything. Your credit didn't have to be any good at all, and you can get a mortgage very quickly and easily. A lot of laws have changed since then that don't even allow the lenders to do those practices anymore. So we are in a much different situation. Actually, as of right now, the borrowers and the buyers in the US housing market currently are some of the most well qualified that you will ever see. So I don't see the home buyers that are just recently purchasing a home the last year or so at inflated or elevated prices defaulting on their mortgages anytime soon. But I think that the interest rate environment that we're in, as well as the inflation environment that we're in, is going to cause a stall, a temporary stall in the housing market, and prices will most likely decline by the end of the year. Now, whether that's 5%, 10%, or 30%, who knows? I would probably err on the side more of a 5 to 10% drop. But the way that the media and everything is now, it will be very interesting to see if there's a 5 or 10% housing decline, what that does when the media is talking about it all day, every day, and what that does to consumer confidence. Do people start spending less because they, mentally in their head, they think that they know that they have less equity in their house than they used to? Are they less likely to go purchase things? And what does that do to the economy? And what does that do to the stock market? As I mentioned earlier, this video is not meant to scare you that the next 2008 Great Recession is imminent, but rather give you some guidance on some data and some indicators that are showing some trends in the housing market that I'm seeing that will help you whether you're a buyer or a seller or a real estate investor in this market going forward. Generally, it's never a bad time to buy real estate as long as your time horizon is at least 7 to 10 years. But if your time horizon is shorter than that, or if you're a real estate investor looking for deals, you may want to start being a little more picky with what you're putting offers on, because I think there's a good possibility that there's going to be more opportunities going forward towards the end of the year. That is it for today, guys. Thank you so much for watching. Let me know what you think about this stuff in the comment section down below. Do you think a housing market crash is going to happen, or do you think it's going to be a softer landing than we all anticipate? Also, if you're interested in getting more housing market update videos just like this one, please consider subscribing down below and hit that notification bell. That way you can stay up to date on all the housing market updates that I give to you guys every few days. Until next time.